Let's focus now on the US stock market and global stocks and the expectations and concerns surrounding AI. We're joined by, Andrew Slimmon, Andrew, Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, great to see you, and thanks for joining us.
Thank you, Andy. Nice to see you.
Start off with the current atmosphere. I mean, December, I know we've seen markets trading near record highs or even hitting record highs, but it's been choppy.
That's correct. The reason why the AI names rallied yesterday is the night before we got some very good earnings, an earnings report from a chip company saying business was very strong. So it seems to me that when the earnings numbers come out and these companies keep telling us they can't keep up with demand, the stocks rally. But in between the earnings reports, when there's less fundamental news, the market gets anxious about all these deals and these stocks sell off. So it's definitely a bipolar environment for these stocks right now.
That's interesting. Yeah, Micron assuring investors that demand is massive for memory chips to help run all this AI stuff. If you had to hazard a prediction for the rest of the year, for the balance of December, what do you think we might see?
Look, at the end of the day, a bubble is excessive valuation. And the reality, I know this is incredible to hear, but the S&P technology sector is trading at a lower forward PE right now than it did at the beginning of the year. And that's because there's so much anxiety about an AI bubble that it's really reined in valuation. Only 2 to 3, I think 2 of the Mag 7 have outperformed, one's on the cusp. So that means 4 of them haven't outperformed the S&P this year, even though earnings have been very strong. So I suspect that there's more to go. In many ways, all the discussion of an AI bubble, it's constraining valuation, and that's ultimately a good thing. You don't want these stocks to run to extremes. Yeah, it'd be good for the market short term because there are big weightings in the index, but it would be bad long term. So I think all this concern is actually long term good news.
We know that companies have talked about massive investments. So actually, I read yesterday in Investors Business Daily, some of these big hyperscalers are saying, we're going to build a data center there and there and there, but they know some of them will be blocked by local opposition. So they're maybe announcing more plans than they actually intend to follow through on.
100%. And you heard also that a private credit company was pulling out of helping to build a data center because it's a publicly traded company, and the market is saying we're worried about how much money you're putting into the AI trade. So all that means, Andy, is that capacity will continue to have a hard time keeping up with demand, and that's going to ultimately give more power to those who have the capacity in terms of pricing.
Apparently one problem with these data centers is noise. Now, I know some of them are remote and they're off in the desert or on some industrial estate, but you don't want to be near one, apparently, because it hums all day and all night with the fans and stuff like that.
Well, I live in the city, so I'm used to that. But yeah, no, that's news to me.
Yeah, the noise is, there's so much unnecessary noise I find in our cities as it is. What is your view on the U.S. banks? Would you be a buyer of the U.S. banks? Would you just buy them and hold them for the long term?
Well, I'm not sure, how long term is, but look, I think there's a lot more to go with these banks, because if you really pour into last quarter's earnings, the reason why they all had good numbers is they have more capital to deploy. So the capital being freed up is going to accelerate earnings, and these stocks still trade at very big discounts to the market. And well, that's because everyone remembers 08, but I think ultimately you have an opportunity here of kind of the nirvana of investing, which is accelerating earnings growth plus PE expansion. That's how you make your big money in stocks. And I think that could be, that started this year, and I think it will continue next year. So yes, I think these stocks are buys.
Because the banks are sitting on vast amounts of undeployed capital.
Exactly.
Yeah, it is interesting. The Financial Times reporting that JP Morgan, well, with interest rates coming down, has taken money out of the Federal Reserve because it earns half nothing there and is putting the money into US bonds as well. In 2026, do you think we'll see any big surprise? Is there something investors you think are underestimating right now?
Well, if I knew that, that would be great. But I think what's important to always consider, Andy, is when is the market vulnerable? Okay, when is the market vulnerable? Mm-hmm. And we started last year very strong. A lot of kind of price targets at the beginning of the year were very lofty, 7,000, which was a long way from 5,800, which is where we started 2020 this year, 2025. And then we get so the market takes off, and then we get a surprise tariffs, and it washed out a lot of the bullish sentiment, and it really reset the market for another run. So I am equally concerned as we start 2026. Seems like Wall Street is pretty optimistic on 2026. We do need a washout. I don't know what it will be. Mm-hmm. I do know that what kills bull markets is the Fed. And it's not valuations, it's the Fed. And so if in fact we got some higher inflation prints, which we certainly didn't yesterday, I think that would cause investors to say, well, wait a minute, maybe the Fed's not on this cutting path as quickly as we think. And that would cause a pause in the market. And I also know that historically, when you have big spikes of inflation, as we did in 2021, 2022, you tend to have a resurgence a few years later. I think that's the biggest risk to the market. We'll have to see.
Yeah, wasn't that the famous thing? William McChesney Martin said the task of the Fed is to take away the punch bowl just as the party gets going. Always that's
exactly right.
A misery guts. Thanks very much, Andrew.
All the best, Andy. Thank you.
Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management.